Ever wondered how Warren Buffett, one of the most successful investors in the world, started his journey? Born in Omaha, Nebraska in 1930, Buffett's interest in business and finance was apparent from a young age. Son of a stockbroker, he grew up in an environment where financial discussions were a part of everyday life. Buffett was not your typical child. While others played outside, he was fascinated by numbers and the concept of investing. This fascination led him to make his first investment at the tender age of 11. Yes, you heard that right, 11. He bought 3 shares of Cities Service, an oil service company, demonstrating his financial acuity early on. He didn't stop there. While still in high school, Buffett was already running his own businesses, including a pinball machine venture. He was laying the groundwork for his future, developing the strategies and philosophies that would make him a billionaire. By the time he was in high school, Buffett was already running his own businesses. His early years laid the foundation for his investment philosophy. As Buffett ventured into the world of investing, a distinct philosophy began to take shape. This philosophy was molded by the teachings of Benjamin Graham, the father of value investing. Buffett was profoundly influenced by Graham's approach towards investing, which emphasized the importance of buying undervalued stocks with a margin of safety. In essence, Graham's approach was about seeing beyond the stock ticker to the actual business behind it. This approach struck a chord with Buffett, who began to view investing as more than just buying and selling stocks. Instead, he saw it as buying a piece of a business. This perspective made him focus on businesses with strong fundamentals, reliable earnings, and good management. The principle of investing with a margin of safety also resonated with Buffett. This meant buying stocks for less than their intrinsic value, providing a cushion against potential losses. From Graham, Buffett learned to view investing as owning a piece of a business, a perspective that would become the cornerstone of his investment philosophy. Despite his initial success, Buffett's investment philosophy didn't remain static. It evolved. While early Buffett was known for hunting down cheap companies, his approach matured over time. He shifted from merely buying low-cost stocks to purchasing quality companies at a reasonable price. This evolution was not a sudden pivot, but a gradual refinement of his investment ethos. Key to this evolution was his partnership with Charlie Munger. Munger's influence cannot be overstated. He introduced Buffett to the concept of quality over quantity. This meant investing in businesses with robust competitive advantages, excellent management, and promising growth prospects, even if they weren't the cheapest stocks on the block. A central tenet that emerged from this evolution is the principle of the circle of competence. Buffett stresses the importance of investing in industries one understands. By sticking to what you know, you reduce the risk of making uninformed investment decisions. Another principle is the holding period forever. Buffett isn't a fan of short-term trading. He believes in buying and holding a company's stock for as long as the company's fundamental business model remains sound. This long-term view aligns with his belief in the power of compounding, as well as his aversion to unnecessary trading costs and taxes. Through his journey, Buffett has demonstrated that flexibility and continuous learning are as essential to investing as they are to life. Buffett's philosophy evolved, reflecting his growing understanding of business quality and long-term value. At its core, what is Warren Buffett's investment philosophy? You might ask. Well, let's delve into the heart of this philosophy, shall we? Warren Buffett's investment philosophy is essentially hinged on 3 fundamental principles. The first of these is value investing. Buffett always seeks to invest in businesses that are undervalued by the market, but which possess intrinsic value. This approach is rooted in the belief that the stock market does not always reflect the true value of a company, and thus, undervalued companies provide an opportunity for significant returns. The second principle is understanding the business. Buffett invests only in businesses that he fully understands, including their operations, competitive advantages, and market position. This understanding allows him to make informed decisions about their long-term profitability. The third principle is long-term investment. Buffett is not one for quick profit-making schemes. Instead, he is a firm believer in the idea that long-term investments yield the greatest returns. This is why he often holds on to his investments for decades. But these principles would mean nothing without 2 key attributes: patience and discipline. Buffett does not rush into investments. He waits for the right opportunities and remains disciplined in his approach, even when the market is highly volatile. In essence, Buffett's philosophy is about understanding a business, recognizing its value, and having the patience and discipline to wait for the right opportunity.